All right, guys, we're back again with another great episode of PFREI, a passion for real estate investments. I'm your host, Gufan Bilal. I am so excited for this guest today. This is actually one of my mentors. Oh man, this is going to be great. David Phelps. David owned and managed a private practice dental office for over 21 years. While still in dental school, he began his first investment in real estate by doing a joint venture with his father on his first rental property in 1980. And 3 years later, they sold that property. David took his $25,000 capital gain share and leveraged that into 31 properties that later produced $15,000 a month of net cash flow. Now, I'm going to finish your bio, but I'm going to stop right there. There's still some people who's struggling to do that today, and you were able to leverage that in the 80s, right? And we'll talk about freedom number and everything else. So at that point, life was good. The sky was the limit. Until that dark day, David's daughter, Jenna, was diagnosed with leukemia. In the midst of cancer treatments, epilepsy, and ultimately liver transfer for Jenna, David made a crucial decision to leave the clinical practice so that he could spend every moment with his daughter. David's plan B, as a portfolio cash flow producer in real estate assets, gave him the freedom to focus 100% on what mattered most. Jenna won the battle with the disease, and David still enjoyed the freedom and to cherish every moment with her that he can. Today, David is a national recognized speaker on creating freedom, building real estate businesses, and investing in real estate. David helps other logical, rational professionals become dreamers, then strategically manifest those dreams into freedom. Under David's leadership, the Freedom Founders Mastermind community grows exponentially year by year, providing the pathway to freedom for many professional practice owners. This is going to be an amazing interview. I just want to go back to something that I learned from you when I started to come into the community and be mentored by you, was you would ask, what is your freedom number? And I'm just going to digress to this for a second, because I remember sitting there and I wrote $50,000 a month. And then someone asked me, what do you want? Helicopters? What do you want? Ferraris? Like, what are you trying to do? Like,
Right.
Why am I killing myself? Why do I need that much money? Right? Why do I need that much cash? I mean, it's great if you do that, but what you have to go through to get that. And I mean, if you want to, take $10-20 million and invest it and make 10% a year and all the other good stuff. But let's and I got all your books here too, man. I got the latest one, Inflation. This was like you like sort of future. Like you've been through market cycles, so you was able to see the future. But
Yeah, I cheat. I take the time machine and go back and go, oh yeah, what was going on then? So I write about it like I was like on the forefront of it all, because I've seen it before, right?
Yeah, I mean, 40 years in the business, right?
Yeah, a little over 40.
A little over 40 years. So let's just talk about right now where we are, the volatility in the market. Everybody is in a panic. It's a lot of market uncertainty. The stock market, you have the cryptocurrency stuff. There's a lot of people that are afraid of the unknown.
Yeah.
And I just want to talk about that. That seems to be the elephant in the room. Even experienced people, like I'm not bulletproof. I told you, I said, hey, I'm not bulletproof. I'm prepared, to do whatever it needs to.
You are bulletproof. I think you've already proven that. I think you've taken a few actual real slugs and you live. So I would call you bulletproof. So I'm just going to put that back on you.
I think it's more than PTSD. Is that it? PTSD or something like that? It's just, I don't know. Is this my spidey senses telling me to pivot through certain things? Is this afraid of being where I was in 2008? $2 million gone, sitting on my bed, watching the ceiling fan, like, what the hell am I going to do now? Because real estate became my identity and I was a slave of money. And now I kind of look at it where it's like, okay, you got to make a pivot. You got to think what's going to happen a year from now. And it's hard to do that because a lot of times you get caught in the trap of working in your business that are on your business. You can't be that visionary. But let's get back to the topic, the volatility in the market. You're out there, constantly talking about it, you've been talking about this for a long time before it even happened, So what's your take on what's happening and what are some of the things people should be cautious of to kind of navigate this market cycle?
Well, we've been overdue for this, no question about it. In fact, I believe right before we actually entered COVID season back in early 2020, that in 2019, we were actually in the position in the marketplace to start to go into a correctional recession. I think we would have hit one then, But COVID hit, and then of course everything scrambled, right? And we know now, in historically retrospect, the Fed, the Fed that comes to the rescue and has been coming to the rescue like multiple times over the last couple of decades, and do the big bailouts. So they came to the rescue again, and this time it was like a massive scale of $5 trillion. They pump into the economy. They hand out the money to consumers, the unemployed, business owners. And I'm not judging that as saying it was a bad thing. They probably did save a lot more pain. It's very inefficient use of capital, but that being what it is with government. But so what that did is, Fuquan, it delayed what I think is the inevitable, delayed that we're going to get a correction. And it's not always this way, but usually the longer you go before you have a reality check in whatever the market might be, the potentially the greater fall can be. Now, again, could this thing stair step, this recession correction that I think we're headed to right now? Could it stair step? Could we have a bounce back? I mean, anything's possible, right? Because we just don't know. There's so many variables involved. But overall, when we have such a parabolic upswing in the markets, I'm talking about financial markets, I'm talking about tangible markets, real estate, but we had this parabolic rise, and the big parabolic rise really happened during COVID, right? I mean, the biggest juice has been during COVID. And now with the Fed having to fight inflation, which, again, I'm not going to point at the Fed and say the Fed caused it all, because there's also Congress that actually sets the regulation, and Congress, has fiscal policy, which means they, allow for these things to happen. So it's a combination. It's not all Jerome Powell's fault or the Fed's fault, but now they're trying to fight what they created, right? So what do? Well, inflation. We're seeing inflation, the after effect of all this money that's put in the market, and that's not good either, especially high inflation. We haven't seen this level of inflation in over 40 years, going back to the 70s and 80s. So now the Fed has to try to fight the inflation. How do you do that? Well, you try to reduce demand, consumer consumption, buying properties, houses, everything, by raising interest rates. So we've had this massive rise in interest rates over the last 9 months, and it is starting to, slow down inflation. You'd think it would, right? But what's the problem? Well, there's always a lag effect of what the Fed does to the overall economy, not the financial markets. You see the financial markets, how quickly they bob and weave and bounce, right? We've seen it this whole year. This whole year, it's been, it's down, and then it pops back up, and
roller
it's
coaster.
down, and it's up.
Roller coaster.
It's a roller coaster. It's crazy. That's why I don't like the financial markets. Now, if you're a gambler, you're a trader, and you like to play all those arbitrage games, day trading, it's nirvana for you, right? That's not who we are. I mean, the people we're talking to, we like long-term investing. We like to look at trends that we can at least have some ability to count on trends, whether they're up, sideways, or going down. We want to see the trend, and that's how we read the tea leaves. So we don't get caught in this trading arbitrage game. There is still arbitrage we use, but I'd say it's a whole lot safer than gambling the way day traders gamble when we have this volatile financial markets. So what's all this mean to us? Well, it's overdue. And, if for people who haven't really been through a major correction, the last one being, how many years ago now? 14 years ago, 2008, 9, 10. If you haven't been through that as an adult or a business owner or investor, then you heard about it, but it's like, you didn't really understand what it was about. And there's a lot of people that fit that category. It's just age, right? Lack of experience and maturity. They're seeing this for the first time. So those are usually the people that are most afraid, because they haven't had any experience of seeing a downturn. It's all been on the upside. Everything's worked. And if something didn't work, the market would just carry it up, and you could bail out, and all sins were basically dissipated by the market, correct? By the market just going up, and there'll always be something to take you out at a higher point. Well, that's not where we are today. Right now, we're in that correction mode. So it's like when a forest, over many years, a forest grows up, right? And you get the big tall trees that are the most stalwart, and they've been there the longest, and they need a certain amount of sunshine, and they need all the other nutrients. And then underneath the big trees, Fuquan, then you all start to have this underbrush. Underbrush starts coming in too, and it starts sucking away from the big trees. That's kind of what we have in the economy right now. We have the stalwart real platforms, the strong investors, the businesses that still run by fundamentals, and we have all this underbrush of speculators that are just eating into all this and causing the exuberance of the market. So from time to time, you have to have a forest fire come in and wash out all the underbrush. That's where we are. So what's it mean to everybody? Well, what it means is different things to different people. I know people like you who have been through this before. Again, not that we have a specific crystal ball to know exactly what's going to happen. We don't. but you've been through it and you know about pivoting and positioning your investments, your platform, so that you stay safe during the gap period while we go through this correction. You know that liquidity and the credit markets may temper down. Even with the rise of interest rates, it's changed the models for a lot of things, right? The exits are taking longer right now than we anticipate because, well, how do you exit when interest rates are up here and no one wants to buy you out up here or refinance you out here? So you know that because you've had experience, and then you prepare for that with your model, you prepare that with your investors, and then you position for the opportunities that will come on the back side of this, because again, in an inefficient marketplace like real estate, that's where our advantage comes from. It's inefficient. The big players who try to play, the hedge funds, yeah, they've had their place, but they can't play like we can. No way. They're like the Titanic, right? The hedge funds, when things are going well, they do well, but when things start to turn, the hedge funds just like they don't know what to do. It's like that's where we come to play, because assets go on sale, don't they? We know assets go on sale. So
you got to be local to the market.
You got to be local to the market, and that's what the big funds can't do. They try to come in with big money, and they have to do it at scale. So they just have to come in and like just obliterate a market. Like, well, just go buy all the houses and properties you can, and pay too much for them because, well, our money's cheap. And they really destroy a market. And that's again part of why we need a recession, just to like knock out all the crazy cheap money that was causing all this distortion. Let's get back to some fundamentals again, where we can actually play ball at a reasonable level.
Yeah, and this gets rid of all the speculators and all of the other guys out there that's not really underwriting these models correctly. I had another name, but it just skipped my mind. So in your book, you said inflation is the silent retirement killer.
Yeah.
And you talk about how to outwit the Fed and their extraction of your wealth. And this book actually came like months ago before, writings on the wall. I remember like third quarter of 2019, he was like, it's time to get your house in order. Make sure that you look at whatever debt you have, whatever credit you have, and get everything in order. And this was before COVID.
Yeah.
And like you said, it was like a dead cat bounce after, COVID. It was a pent up demand for certain things. And I think, like you said, when things are leveling off now, it's pretty much fair game. I feel like we have probably, and I don't have a crystal ball, but going through these increases from the Fed and getting through first quarter, second quarter of 2023, I think it's going to probably be at least 18 months. That's what I'm planning for, 18 to 24 months. So just trying to, work on increasing cash flow. What are some of the things that you see that will help people get through the gap?
Well, people on a personal level, consumption level, it's similar. I mean, I think you have to look at, well, how much debt are you carrying? Personal type of debt. Do you carry credit cards? Do you have lines of credit open? Things that the floating rate. Or high levels of debt where you're paying, a higher interest rate and it's sucking away your cash flow. I mean, cash flow is king. Cash and cash flow are king in times where there's a market turn. You need to have that. That's like oxygen, right? And so you want to make sure you've got the oxygen there to carry you through. So if your margins are tight right now with cash flow, you need to start looking at how you can open up more oxygen, more cash flow by selling some stuff off or resetting some debt if you can do that, or paying some off perhaps if it makes sense. So that's on a personal level. I think certainly you can look at life, your own lifestyle, and what right now could you cut out that would give you more margin. It's all about having that margin to get through whatever we need to get through. To your point, I think 18 months would be a good target to look at. What do I need to do to get through 18 months? If these things happen here and I have a slowdown in my business, or maybe I have less hours at work, or you got to stress test at different levels, right? That's what we do in our group, and what you do with your platform, you stress test it, right? So stress test at different levels and say, well, if things got to this level where I had 20% less in income for different reasons, could I manage that? If I can't, then well, is that what I needed to get there? So that's number one. So that would be for business, for personal. I mean, business, very similar. Business, same thing with operations and cash flow. You've got to get leaner right now, and unfortunately, sometimes that means some cases it might mean letting some people go that are not adding value to the company, or getting more from fewer and better people. Look at your overall overhead in that regard. investing. I mean, that's the other thing. So if you're also an investor and you're looking at, well, how do I position myself? I think if you're a boots on the ground investor like you are, well, you've got eyes on everything you're doing, and so you know what you're doing there. Most people like me we're more passive, and so we depend upon people like you, Fuquan, who we number one develop a relationship with. So knowing you as I've known you for many, many years, I've got to know you as a person, not just a capital investor, sponsor, syndicator, etc. I know you got to know you first as a person. I mean, that, getting to know you, your family, we've talked a lot, we spent time together. I think that's a relationship. So knowing who you want to do business with, whether it's investing or being in business with per se, you got to know who the people are, because when times get difficult, you want to know who's been there and who is kind of that warrior mentality, who will say, okay, yeah, things are could get tough here, but I've been there before. I've got the resiliency, the perseverance. I'll do what it takes to get there. That's who I want to ride with. I don't expect you to be perfect. I don't expect your crystal ball to give you the same returns I've been getting in the last 3 years. I tell people, don't expect it. Be happy with what the market gives you. And if you're the one operating, or you have somebody you're operating through, they're going to do the best they can in the market. And then, of course, on the other side, 12, 18, 24 months, thereabouts, there'll be some great opportunities. And so again, I want to be there with people like you who are local to the market, and you have those relationships I don't have. That's not what I do, but you have those relationships. You've built those. That's the advent of the inefficiency of the real estate market is inside information is legal. It's okay.
Yeah. So we had a big debate a few years ago. It was equity versus debt. I want to spin that around right now in this market. Okay. For investors, debt is cash flow. You have some debt investments, it's cash flow, and equity is long term for growth. Mm-hmm. And what would you say now in this current market? What would you be doing, equity or debt investment that you have cash flow?
Yeah, no, that's you're right. We've had that debate, and I think that debate is always a reasonable debate to have, because market conditions change, right? And so your allocation between the two, and I think you want to look at having some allocation between the two. I think there's reasons to have equity. We can certainly talk about what those are, and there's reason to have debt on both sides in different buckets of money and all the different variables that you look at. But I think the allocations can change in the marketplace. So in general, and I'm speaking very generally, because there can be specific instances or opportunities that certain people have, and they go, that is a great equity investment. I want to, have a piece of that. I want to buy that. That's what you do. You see an equity investment, and you have your criteria, your box, where in this marketplace you stress test at different levels. You go, okay, based on my criteria, this equity investment still makes sense. All right, you tell me what that is, and if I agree with you, I go, I'm in, right? But in general, equity investments, and you can tell me what you see because you're in the market, I think they're probably fewer and farther between than we had, just a year or 2 or 3 years ago, where you could look at something, and with low interest rates and everything's still going up and up and up, and rents going up just like precipitously, you say, yeah, I can buy it here, and suckers, going to be up in 18 months, and we'll be cash flowing big time, or we could exit this thing at a nice multiple. Sounds great. Well, right now, I think still well-managed equities can get through this, but I don't think that quick pop, that quick IRR, that quick equity multiple is going to be there as quickly. So you have to look maybe a little longer term. Nothing wrong with that. Nothing wrong with that at all. I like long-term money. Debt side, yeah, potentially you position yourself as a debt lender or investing in debt or lending money. You can choose, again, your operator, their borrower. I mean, choose them first, right? Like them, operator, and then cut the cards by saying, well, what's the loan value I want to go with here? Do I need extra collateral? Blah, blah, blah. There's lots of ways to, protect and mitigate risk. And as a lender, you get to kind of choose that. Might be in general, a little bit safer position to be in that debt side of the capital stack in general, the way you set those up. But again, I think you need some of both. There's going to be some balance. There's going to be something based on where you are in your life and what your portfolio looks like. And, those are the important things that you have to look at.
Safe answer.
Safe answer. Yeah. Well, I
know
that one, didn't I?
I know last time equity won a debate because we were in that market where things were rising and rents were increasing and rates were super low. And yeah. So why are you passionate for real estate investing, Dave? I usually ask everyone that question.
Oh yeah, man. Well, that just goes back to 40 plus years ago when I was in college and I was reading books about, trying to learn how to be an investor. I always wanted to be an investor, right? I wanted to be a good steward of investing money that I didn't have back then, but I thought I need to be thinking about this, right? And so when I read books about investing on Wall Street, basically stocks or they had just started coming out with mutual funds back in those days when I was in the 70s. Mutual funds were just kind of like beginning their stride. And there's lots of books about that. And then I picked up some books about real estate, and I read the books and compared and contrasted, and like real estate just like made sense, right? I mean, it just made sense. Logical me. I gotta have something that I can see, it's tangible, and I can see where if I want some control over it, which is what we get to have with real estate, I got some control over it, local market conditions, all those things that you talked about. I can negotiate with a seller that's more my level, and I'm not playing the Wall Street game, which would never be my game. I just love real estate, and so I started with that back in 1980 with that first property you talked about that I cashed out 25,000 give or take, and parlay that into more because I could leverage and learning how to leverage the right way. Well, using debt, well, is that scary? Well, not if you do it the right way, right? I mean, you have to learn how to use debt properly, but debt is one of the great assets that make real estate for us, smaller retail, small balance real estate investors. It makes it very, very viable for us to do it the right way.
Yeah, that's awesome. And I see you have your books in the background, but it's ironic that you have the 3 books that I actually have: the Inflation, the Own Your Freedom. I have 2 copies of that, by the way. and What's Your Next? So let me before I jump into the What's Your Next, I actually have 2 copies of this book, and I have 1 copy because this thing came packaged so nice with the I've never seen this before. Come with it, but you got the marketing. Oh man, the packaging it's amazing. So this one is the showpiece.
We only did that for you. You got the only one.
But What's Your Next is the one that I want to jump into real quick. A lot of people, when they get their freedom number and they get to a point where they have that financial freedom, so to speak, and then we know at the top of the pyramid, the next is impact. You see a lot of people struggling with that because they lose their identity. They transition from what they were doing full time. Now they have this cash flow nest egg they built up. And I speak to a lot of busy professionals when they reach that level, and I go, hey, so what's next? I'm still trying to figure it out. And it's like they're in an identity loss, and they don't know which direction to go.
That's exactly
on that?
That's exactly what it is. It's loss of identity because to a great extent, we go to school to whatever level we go to school, and it could be vocational school, which is be awesome, or college, or whatever we get whatever degrees we need to go forward with a career path. And I guess the more specialized one becomes, the more entrenched you're going to be in that career path, probably longer. And so that becomes your identity. And that identity is something that it gives us respect. It gives us self-confidence, self-esteem. So I'll just, use the one, I sort of got used to, although I took that hat off and kind of dumped it. I don't really care. It doesn't matter to me anymore. But, I was a doctor. I mean, a practicing doctor. I guess I'm still a doctor, from my credentials, but you wouldn't want me practicing on you anymore. I'll just be clear about that. I didn't go back to school, but that's identity, right? So if you have those credentials, you got letters after your name or whatever, right? I mean, or you have a certain business that has a name calling to it. Well, people identify you by that. You go to church, you go to your local community, and I don't know, certainly it has a good feeling to it, right? And then you get to a point where you have that freedom number, and you've been in that certain one business career, that trench. And, if it's repeatable over many, many years, it's kind of the same thing. Look, eventually everybody burns out. Now, the cool thing about what you do is you get to always pivot. I'm not saying that you couldn't burn out at some point, but you got way too much energy, way too much left in you to ever burn out. So you're in a place where you didn't let yourself get pinned down. You took opportunities, some things in life forced you to make some changes, and you took that opportunity. But sometimes people get in these careers where they just have to stay there because of sunk cost fallacy. You put so much time, so much money into the education and capital into that thing, and it's like, well, I could never change this because I've just put so much into it, and that pins them back. So now they hit the freedom number, and now they can escape. We call it in dentistry, escape the chair, right? You escape the chair, the dental chair. You get to escape it, and you go, wow, this is great. And then all of a sudden, it's like you're at that point on the cliff, and someone gives you a bungee cord and goes, "Trust me, it's safe. You can jump." And you go, "Is it really? Is it really?" You're looking back behind. Is it really? Do I really jump? Because you don't trust that next step. And I've seen people sabotage their opportunity to have that new freedom that we talk about so much. They sabotage it, self-sabotage it by making up reasons why the exit, the sale to the next business owner or doctor or whatever, they sabotage it. It doesn't go through because they're afraid to let go of that. And yet they want it, but then they don't want it. And so what's your next is really becomes a perplexing problem for a lot of people that don't see it coming. They don't see it coming until they get right there. And so building out, a game plan where you can start developing those extra interests, those other interests while you're on that path is what I try to help people do before they get there. Otherwise, it can be difficult because we both know people that have lived very strong, very serving lives, and that's great. And then they get to that quote retirement age, and often what happens, Fuquan, right? They don't feel any relevance anymore. I mean, they're categorized in this retired. I'll go play some golf a little bit, and then like their mind quits working, and they're just not in the game anymore, and they lose that feeling of purpose. And oftentimes, people's health goes downhill. Sometimes quickly after that. Not always, but oftentimes you see that happen. And I think today, with medicine today, and most people taking more conscientious look at their health, like I know you do, potential to live a lot longer life and not think that 65 is old. When I was younger, I thought 65, that's really old. It's like, well, I'm 65 now, so that's not old. It's not old at all. I tell everybody that's not old. I don't even think 85 is old anymore, right? I'm pushing for 105, and maybe that's
you'll make it. You have much energy.
Maybe a senior status at 105. Maybe then I'll accept the AARP and the Wheels on Meals or Meals on Wheels or whatever it is. Maybe then, but I'm not taking those cards yet.
Yeah. You'll make it. You have so much energy, my friend. Oh man, this is a great show. It was a plum pleasing pleasure, as Les Brown would say, to have you on the show today. It's been a great show. All right, guys, we're getting back. We're back like we never left. I actually did 108 episodes, and then I went on a hiatus for like 10 months because I was like, I got to focus on my business. Podcasts are great, and I learned so much from podcasts. And then I kind of fell off the radar for a minute, and I was like, I got to come back. So we're back like we never left. It's another great episode, PFREI, Passion for Real Estate Investments. I'm your host, Fuquan Bilal. Be sure to, if you catch us on YouTube, to like and subscribe. Check us out on iTunes and all the other places you can catch podcasts. This was a great episode. I really appreciate you coming on and sharing some value with us today.
Hey, it was fun. And I'm glad you're back to the podcasting arena. I am glad you're back. Yeah.
Back like I never left.
That's right.
All right.